Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I think I deserve a like just for the tie. Now I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. Today we'll be discussing the difference between long-term stock investing, including investing for dividends, and compare this style to day trading, swing trading, and options trading, which will have a separate video just for the options. Let's define investing versus trading. So an investor looks to profit over time, usually longer term, 2 to 30 years holding time possibly, and often targets stocks that pay dividends over time and increase the dividends over time. A trader, however, buys and sells frequently, using market volatility to make money. Shorter term could be same day buy and sell to a few weeks holding time is what the traders do. It's riskier than investing, sometimes yielding only a fraction of a percent, but in a short time frame. You may also need to do it full time, since a trader needs to watch the market for an entry point and then keep an eye on the purchase. Trading could be day trading, where you get in and out the same day, or it could be swing trading or momentum trading, where you hold a stock for longer than one day, but usually a few weeks at the most. So we have investing, which is long term, sometimes for dividends, and then we have trading, which could be same day or it could be a couple of weeks, but it's not intended to be long term. Let's look at the differences in analysis that investors and traders use. So investors will use fundamental analysis to find the intrinsic or real value using the fundamental analysis. So you're looking at the business model, the balance sheet, the income statement, the cash flow, the competitors, macroeconomic factors that affect the company, market trends, etc. Investors try to buy a stock for less than it's worth and expect the market to recognize the intrinsic value later, and the company to increase its value over time as well. As the value goes up, it may not matter if the investor purchased the stock at a higher price than at the very bottom, since the company's price goes up anyway due to the return of the price to the intrinsic level. And of course, you also have the rise of the intrinsic value overall as the company improves itself and grows bigger. On the other hand, traders only care about the stock's price without trying to determine the stock's intrinsic value. They look at the historical price and trading volume information only and make decisions based on various patterns and calculations. So they will look for trends in the charts, and that allows them to profit. This is called technical analysis or charting. Fundamental analysis has to be for long-term investments. It cannot be used for short-term. Technical analysis is either short-term or long-term, but it's typically used for day trading and swing trading. Personally, I do fundamental analysis, and I am just now starting to look at basic technical and charting because I'm doing options trading, which is short-term, and it helps to know which way the stock will go in the next month. I don't really want to be a day trader myself because you end up waiting for a confluence of several factors for you to jump into a stock, and you could earn nothing if these factors don't occur, but you still spend the entire day in front of a PC looking at the screen. Short-term trading is more speculation than investing, and please see a video linked above where I compare investing to speculation. Short-term trading ends up using charting or technical analysis, which uses many indicators just to analyze the price and volume traded of the particular asset. Now, technical analysis is kind of cool since it can be used to trade anything, so gold or currency, which have no balance sheet and no business model. And it can also be used for long-term without knowing anything about the asset. For the rest of the video, we're going to look at technical analysis exclusively because the rest of my videos have been devoted to the fundamental analysis. There are many tools for technical analysis. I took a screenshot from a technical analysis website, and I don't think this is anywhere near the full set. It allows the user to forecast the prices, or at least the direction of the movement of the stock, which is sometimes all that you need. I will cover just a few of the tools. Note that technical traders will have several favored indicators, and when they see a confluence of most of them, or the main indicators going in their favor, they will buy a stock. In some cases, the trader just needs a trend and a direction of the stock in the short term, such as myself when I am selling puts. The most basic indicator and tool are the resistance and support lines. So support can occur where a downtrend is expected to pause due to concentration of demand. Resistance occurs where an uptrend is expected to pause temporarily due to concentration of supply of the stock. There is something at that price level that gives the market pause, basically. Now, if the stock is able to break through the resistance level on the way up, the resistance line becomes a support line because there is something about that price level. If a stock breaks through a support line on the way down, that line becomes a resistance line. Support and resistance lines are horizontal. Next, we have trend lines. A trend line forms a channel for the stock price, acting as a support and resistance, but also giving the user a direction and a trend. They don't have to be horizontal. Next is moving averages, which is just an average of the stock price going X days back at any time. An indicator for a trader is when the stock price crosses over the 7, 100, or 200-day moving average. It's a reason to sell if it crosses down or buy if it crosses up. And some traders will also use a one standard deviation Bollinger Band around the moving average as a warning, as you can see in this market directional strategy. Elliot waves are a tool that uses the theory that there are 5 waves or legs from the bottom to the top, and then you have 3 legs down to the bottom. Therefore, this allows the user to know which way the stock price is going. Next, we have the golden and death crosses. So these occur when the 50-day moving average crosses over the 200-day moving average. If the 50-day is crossing up, the price is likely to continue up, and so this is the golden cross. If it is crossing down, then it is thought that the stock price will continue down, and so then this is the death cross. The Fibonacci series that you may remember from high school of 1, 1, 2, 3, 5, 8, etc., where a number in the series is always the sum of the two previous, is used to put a static price level between a peak and a valley in a stock price, and this can then be used to place entry orders, determine exit levels, or set price target by putting in the fixed price levels based on the series. Fibonacci levels are static prices that don't change, unlike the moving averages. The static nature of the price levels allows for quick and easy identification. That helps the traders and investors to anticipate and react prudently when price levels are reached. A very simple indicator is the volume, where high volume confirms the other indicators. That is, the other indicators are solid if they had a lot of trading behind them. Getting into the more mathematical indicators, we have the CCI, the Commodity Channel Index, which sets boundaries over which a stock is overbought or under which it is oversold. It is a momentum-based index used to help determine when an asset is reaching a condition of being overbought or oversold. It is also used to assess price, trend, direction, and strength. The RSI, or the Relative Strength Indicator, compares the relationship between the averages of the up closes, where the stock ended the day up, versus the average of the down closes, where the stock ended the day down, over specific time intervals, usually 14 days, as you can see from the screenshot. Values produced by its formula are then plotted on a moving line underneath the price chart. All readings oscillate between 0 and 100 with a midpoint of 50, allowing for easy readings about potential overbought above 70 and oversold below 30 levels. And lastly, we have the MACD, or the Moving Average Convergence Divergence, which calculates the difference between an asset's 26-day and 12-day exponential moving averages tracked at the end of each trading day. On the MACD chart, a 9-day EMA of the MACD itself is plotted as well, and it acts as a trigger for buy and sell decisions. The MACD generates a bullish signal when it moves above its own 9-day EMA, and it sends a sell signal when it moves below its 9-day EMA. To summarize, there are two main ways to determine when to buy or sell a stock. You have fundamental analysis, which is used for long-term investing, and technical analysis or charting, which can be used for either short or long-term investing, but are typically used for the short term, using various indicators for entry into and exit out of the market, and they enable the user to get the direction of the stock it's heading in the short term. As usual, if you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.